For more than a century, Wall Street has run on exchanges, brokers, clearing systems, settlement rules, market hours, and layers of financial infrastructure most people never see. You buy a stock in seconds, but behind that click is a complex machine. Now, a new idea is challenging that machine. What if stocks could trade on blockchain? What if Apple, Tesla, Nvidia, or an index fund could exist as digital tokens? What if markets could trade almost 24 hours a day, settle faster, and become accessible to investors around the world in smaller pieces? This is the idea behind tokenized stocks, and if it works, it could change how people invest. But if it goes wrong, it could also create a new layer of confusion and risk. A tokenized stock is a digital representation of a real stock or stock-like exposure on a blockchain. In the simplest version, a regulated company holds real shares and investors trade digital tokens linked to those shares. The promise is attractive: faster settlement, fractional ownership, lower costs, global access, potentially longer trading hours, and a financial system that feels more like the internet. To crypto believers, this is obvious. If money can move on-chain, why not stocks? If stablecoins can settle quickly, why should stock markets still rely on old plumbing? If people around the world want exposure to U.S. companies, why should borders and brokers make it difficult? That is the optimistic version. Tokenization could make markets more efficient, more open, and more programmable. But Wall Street is not a simple machine, and stocks are not just numbers moving on a screen. They come with rights, rules, custody, disclosures, dividends, voting, market structure, investor protection, and legal ownership. That is where the revolution becomes complicated. The first big question is ownership. If you buy a tokenized stock, do you actually own the underlying share? Do you get voting rights? Do you receive dividends in the same way? What happens if the company issuing the token fails? Who holds the real shares? Who audits them? Who makes sure every token is properly backed? These questions matter because finance has already seen what happens when people trust digital claims without enough transparency. A token is only as strong as the legal structure behind it. The second question is liquidity. A market that is open all day sounds exciting, but it needs buyers and sellers. If trading happens across many platforms, prices can fragment. One tokenized version of a stock might trade at one price, while the real stock trades somewhere else. In calm times, that difference may be small. In panic, it could become dangerous. Traditional markets have rules for halts, disclosures, settlement, and manipulation. Tokenized markets need equally strong safeguards. Otherwise, the future of finance could look fast but fragile. The third question is regulation. Stocks are heavily regulated for a reason. Companies must disclose information. Brokers must follow rules. Exchanges must monitor trading. Investors have protections. If tokenized stocks are allowed to grow under lighter rules, some people will call it innovation. Others will call it a loophole. That debate is already beginning. Crypto companies want room to experiment. Traditional market firms want fairness and investor protection. Regulators want innovation without chaos. Investors want access without being exploited. Everyone says they want a better market, but they do not all agree on who should control it. The fourth question is why Wall Street is interested at all. For years, traditional finance dismissed crypto as speculative, but blockchain technology offers something Wall Street does care about: efficiency. Settlement can be slow and expensive. Back-office systems are complex. Global trading access can be limited. Tokenization promises to reduce friction, and Wall Street loves anything that can create a new market, new fees, new products, and new customers. That is why this is not just a crypto story anymore. It is a Wall Street story. Big exchanges, brokers, fintech firms, and asset managers are watching tokenization because they know the future may not look like the past. The fifth question is what this means for normal investors. The good version is powerful. A small investor could buy fractional exposure to expensive stocks. International investors could access markets more easily. Trades could settle faster. Ownership could become more transparent. Financial products could become more flexible. But the bad version is also possible. Investors may buy products they do not understand. Fake tokens may appear. Platforms may promise stock exposure without strong backing. People may confuse tokenized products with real shareholder ownership. 24/7 markets may encourage overtrading, and scams may use the language of tokenization to look legitimate. So the technology is not automatically good or bad. The structure matters. Who issues the token? Who holds the shares? What rights does the investor have? What happens in bankruptcy? Who regulates the market? How is manipulation prevented? Those are the real questions. The climax is this: tokenized stocks are not just about putting Wall Street on blockchain. They are about whether the next version of finance will be more open or just more complicated. Because the old system has problems. It can be slow, expensive, exclusive, and outdated. But the old system also has protections built from decades of financial mistakes. The new system may be faster, but faster is not the same as safer. That is the balance investors need to understand. The future of investing may not arrive as a revolution overnight. It may arrive one token at a time. And by the time most people noticed, the market they thought they understood may already be changing underneath them. The reason this matters is that tokenization could change not only how people buy assets, but how markets are designed. Imagine a world where a person in one country can buy a tiny piece of a US stock using a digital wallet. Imagine dividends paid automatically. Imagine ownership records updated instantly. Imagine assets moving between platforms the way information moves across the internet. That is the dream. But finance is not only about speed, it is about trust. If a market moves faster than the legal protections behind it, the investor may not understand what they actually own until something goes wrong. This is especially important for ordinary people. Big institutions have lawyers, compliance teams, risk departments, and access to information. A normal investor may only see a clean app, a token price, and a button that says buy. If tokenized stocks become mainstream, the winners could be huge. Exchanges, crypto platforms, banks, asset managers, and payment companies may all fight for control of the new rails. Whoever controls the rails can collect fees, data, liquidity, and power. So this is not just a technology story, it is a control story. Wall Street may be moving to blockchain, but the biggest question is whether that makes finance more open for everyone, or simply creates a new version of the same system with new gatekeepers. And in the end, finance is not just about numbers on a screen. It is about the choices we make, the systems we live in, and the future we are trying to protect. If this video helped you see money a little differently, subscribe to the channel for more clear and honest finance breakdowns. Thanks for watching.